Afternoon. This is Jim Barlow with OakTree Strategic Leverage, and we're going to talk about family gifting today. Is there a better way? A transformative approach to family gifting using my Inversion wealth framework. So I keep boiling this down to smaller words, but about me, a lifelong resident of Clearfield, Utah, married to Barbara, 7 children, 28 grandchildren, a BYU graduate, devoted fan, investment advisor for over 35 years. Our passions, family. Family's everything. We love to travel. We like to be together. We read, go to plays. We serve in the temple. The last 2 weeks I was in Orlando, so those are, if you watch those webinars, but I'm back home. So why OakTree? I didn't retire from purpose. I built OakTree because I believe there's a better way to protect more, keep more, and do more. With what you're built, time may have changed my role, but it doesn't take away my calling. I'm still striving, still seeking, still helping others find a better way. I enjoy this. So, is there a better way, a transformative approach to family gifting? Win without losing. Wow, that'd be wonderful. Family gifting changes everything. You're no longer just building wealth. You're deciding how to leave it. How you leave it to time. Timing now matters. Control now matters. Taxes now matter. Decisions shifts to others. The question is no longer how do I grow it. The question now is what happens to it next? What should I do? How do I want to do this? The hidden risk of gifting where family wealth is actually lost. Most wealth doesn't disappear in the market, it disappears in the transfer. Poor timing, unplanned taxes, lost control, forced decisions by the next generation. What took a lifetime to build can be undone in a moment. I'm sure you've seen that. The traditional way of gifting falls short. Most gifting strategies focus on the wrong thing. How much should I give? When should I give it? Who should receive it? But they rarely ask what could go wrong? A better question. Before deciding how to give, ask what could destroy this outcome. What creates regret? What removes control? What creates conflict or inefficiencies? Because in family gifting, avoiding mistakes matters more than maximizing returns. What people really want, what family gifting is really about. It's not about the money, it's about providing security, creating fairness, preserving values, strengthening, not straining relationships. I'm sure you've seen some of that last one on discussions about fairness and preserving values. Oh, wow. The goal isn't just transfer, it's a successful outcome. How wealth actually moves automatically by beneficiaries. If you have a beneficiary on a life insurance policy, that's who it's going to. Legal, wills, and probate. The legal, you have a will, or if you don't have a will, those are probate court. Trust-based, controlled structures. Strategic, insurance, business planning. Lifetime gifting, where decisions matter most. Levels of giving. Level 1, simple. Give an amount directly to someone. Or level 2, transfer the assets. You transfer ownership of the assets. Or 3, structured transfers. Some controls. You design how and when and why wealth moves. You structure this. Where design replaces hope. Inversion thinking. Not going to talk about a lot about this, but inversion thinking, it's a way of solving problems backward. Instead of asking, how do I succeed in retirement or gifting, you ask, what would cause my retirement plan to fail? Then you eliminate those risks first, because in retirement, it's not the average return determines success, is whether the plan survives. The Inversion Wealth Framework. This is the framework I've developed to help people. It's a pyramid structure. First, you start at the base and you think about and look over and decide what could ruin this program. Inversion thinking, thinking backwards. Then once you have where the problems are, then you build a structure, a system that's going to fulfill that inversion rules. And that's the two critical ones. But because if you get the structure right, then you can do some leverage, multiplication, and then let this thing compound, the 4 steps. Let's talk about these 4 steps briefly. Inversion. Avoid ruin first. Identify what could destroy wealth. Eliminate irreversible risks. Expose hidden vulnerabilities. Find out, look over it, really discover it. This is where you win by not losing. Build what cannot break. Protect against sequence risk. Maintaining control of timing, designed for stress, not perfection. Structure is the edge. Performance is the outcome of this structure. Leverage. Amplify only after protection. In ours, we use institutional capital, 3-to-1 leverage. We avoid personal guarantees. We align borrowing with design. Leverage is powerful when it's controlled. Then, patience. Let time do the heavy lifting. Allow compounding to work. Avoid emotional decisions. Stay committed to the structure. Only what survives can compound. This framework, same, but the inversion wealth framework applied to family gifting. Version, avoid loss through poor timing, taxes, decisions. Structure, control how, when, and why wealth transfers. Leverage, amplify what you pass on. Patience, let compounding do the heavy lifting. Transfer is not the goal, it's the final test of the structure. The gap. Most plans are built for accumulation, not transfer. Built to grow, not built to transfer efficiently, not built to preserve control, not built for real-world timing. That's the missing piece. A different approach. Designed for efficient wealth transfer, tax-aware distribution, control across generations, timing, flexibility. Structured for the moment most transfers fail. Wealth transfer success isn't about giving more, it's about losing less to taxes, timing, and decisions. If we know what destroys wealth transfer, and we know what a strong transfer structure requires, is there a system designed to solve for all this? Minimize tax erosion, preserve control across generations, protect assets from poor timing and decisions, provide structured, intentional distributions? Or are we left hoping our plan holds when transfer matters most? Well, I found a program that meets the inversion strategy and meets all these requirements. A company out of Plano, Texas called NIW came up with this. I deal with them a lot. I know them all the owners. Kaizen, that's the name of the product they built. Kaizen is a Japanese word meaning continuous improvement. Don't you like that phrase, continuous improvement? They actually want to see wherever they need, they want to tweak Kaizen and make it better all the time. Their buzz phrase is more money, more protection, more confidence. So let's get into Kaizen. Kaizen, a transformational structure built on an index universal life policy that eliminates downside risk. Wow. Uses institutional leverage, creates tax efficient income. Actually, it's going to be tax free. Defines a clear exit strategy. Simple on one slide. How does it work? You contribute capital for 5 years. That's it for sure. The bank contributes additional capital alongside you for those 5 years. Then the bank continues funding for the next 5 years, so a total of 10. The policy grows with built-in protection, and then this loan is repaid around year 15. From that point forward, the structure is fully yours, unencumbered, income ready. Why it fits the framework. Downside protection, inversion, structure, defined system, not market guessing, 3-to-1 leverage, long-term compounding. It's used, these are the top 6, I think. Used for retirement income, family gifting, which we're talking about today, executive and employee retention, business succession planning, creditor protection, tax efficient. There's others, but these are probably the top 6. Who's it for? It's not for everybody. Best fit for high income earners, business owners, professionals, families thinking generationally. Qualifications. Oh, I want to change that word, typical. It's really 18 to 65. Can't buy it below or above. Health and good health. Average or excellent. Income, approximately 200,000. That's who it's going to fit for. Plan funding. The minimum for those 5 years is, depending on age, really, is 22 to 32. The minimum depends on how old you are, what the minimum would be. Commitment, long term, before we pay off the bank. Guidelines vary by carrier, individual circumstance, but that's generally the qualifications. The reality of risk, every strategy has trade-offs. If a strategy doesn't have risk, it's not real. The question isn't, are there risks? The better question is, are the risks designed for or ignored? Most financial plans try to outperform risk. Few are designed to manage it. Understanding the trade-offs, the real risk and why they exist. Complexity, do-it-yourself friendly, requires coordinated structure and oversight. Sorry. Commitment risk, 5-year funding, that's pretty short, but it's still there. Liquidity constraints, early years. It's not growing like an investment very well in early years because of insurance costs. Designed for long-term, not short-term access. Higher cost is the structure of the insurance. There's a lot of lower cost items that I'll show you, but it's front-loaded for long-term outcomes. Policy performance risk depends on long-term index crediting, obviously. Designed for risk, not just return, a different approach. Most strategies try to outperform risk. This one designed to absorb and manage it. Market loss, there is none. Zero downside floor. Bad timing, structured liquidity design. Emotional decisions, predefined system. Uncontrolled leverage, defined lending. Ongoing complexity, institutional oversight. Structures the edge, and then you'll get the performance. Goal isn't to eliminate risk, it's to eliminate the risks that cause permanent damage. There's 4 major categories and things about Kaizen that I've figured out. I'm going to talk about these are in the next few slides. I'm going to give you all the features of Kaizen. Write down questions. We're obviously in a webinar, we're not going to answer them all well, but first we're going to start with a foundation. There's the protection side. There's the death benefit. This is a life insurance policy. Transfer wealth efficiently. Some people say, well, I don't need life insurance. Well, you'll see as we look this over that it almost becomes a benefit on the side because this grows so well. Living benefits, protection when life doesn't go planned. Let me jump ahead on this slide. Living benefits pays you a lump sum for major health events, critical injury, support for severe injuries, chronic illness, access fund for long-term care, terminal illness, early access to the death benefit, cognitive impairment. In today's day and age, you want these coverages for living benefits because we don't know what the future holds. So you're getting that. You're getting the death benefit, these living benefits. Then foundation is tax-free growth and access. When an insurance policy owner dies, the assets that grew inside the policy goes to the beneficiaries tax-free. That's been the case in the day one of income taxes in what is 1918, I believe. I don't think it will ever change, tax-free to the beneficiaries. But as the owner of this policy who has not died, you can borrow against this policy tax-free. I'm going to show you how that kind of works. That's a cool benefit. And there's some efficiencies. There's no ongoing advisory fee or management fee, so we've eliminated some costs. That's the foundation. Then the growth. Participate in growth with no exposure to capital loss. Zero downside floor. Lost years are eliminated. I'm going to show you how that happens. And your money is invested in market-linked growth. You participate in market gains. And you don't have to recover from a downturn because you don't have any downturns. You have continuous compounding. No recovery years required. This is this part is something most people really want. So how indexing works in an index universal life. Most of the premium is allocated to high-grade bonds, protection, with a smaller portion used for index options. For example, a $1,000 premium beyond the insurance costs, let's say $950 goes to bonds. grows back to 1,000 1 year later. Then the $50 is put into options linked to different indexes that you choose. Protection first, growth second. That sequencing is what makes the structure transformative. Here's an example of a couple options in those indexes of national life. All these policies will have basically similar things, but more option than the two I'm showing you. So if you invest in their S&P 500 index, you're buying an index in the whole market, and you get 100% of the participation, but you'll be capped on the return. That's the current cap on April 11th. Here's the example of returns in this category for 5, 10, and 15 years. Nice returns, no downside. Another approach is volatility controlled indexes, and this is called the US Pacesetter. There's no cap, and I like that. And currently it's a participation rate of 260%. Because it's a lower volatility index, you get pretty nice returns because of the 260% currently. So there's the averages for 5, 10, and 15 years. That's where the index money, the option money, goes to buy these things. Control. Maintain control. This is where NIW put a lot of sweat and tears into building Kaizen. Protected ownership. They set it up in a trust. And your trust is a trust set up in your name. So the trust owns the policy. And they have a master trust that doing the heavy lifting, the borrowing. That gives protection. And the trust happens to be a major company is out of Las Vegas, and Nevada has the best creditor protection laws of any state. So you have creditor protection because of this protected ownership mix. Finite funding, we've talked about this, only 5 years of contributions. That's it. They add a bunch of riders designed to reinforce control, protect the structure. Sometime I'm going to do a webinar on just all the riders. That'll be a whole webinar. Flexible liquidity. After you've put in the time, you have, after these 15 years and we get rid of the bank, you have access to cash value without taxes, no forced withdrawals, no RMDs. You have major flexibility after that. And it's very turnkey. Minimal management required. This is not something that you need to be watching every day or every week or every month. Once a year. This is the control part. Then, because we have these controls and we have the no downside and we have the tax-free, let's do some leverage. We use the institutional leverage, about 3-to-1. Non-recourse structure, no personal guarantees or outside collateral. Accelerated outcomes. Because of the 3-to-1, you reach your objective sooner. You're using other people's money. Capital use. You could leave investments to where you want them and just only a portion liquidate for this because you can keep things where you want to have them. So that's the leverage part. Here's a visual. The silver pegs represent the 5 years of funding on your part. The gold pegs right under it is the 5 years of funding by the bank during the first 5 years. After the 5 years, they continue doing that payment they were doing, but they actually pick up your payment that you're paying and do it for 5 years. And then that's the funding through 10 years. And it's roughly 3-to-1. If you're putting 100,000 in, they're putting in roughly 300. If you're putting in $1 million, they're putting in $3 million, and with no personal guarantees, no outside collateral, no traditional loan process, institutional underwriting built into the structure. Wow. This isn't about eliminating risks. We've covered the risks, and we've gone with leverage because we can, because we protected the downside. Structuring so it can't break. Yes, there is life insurance cost. And unlike traditional investment fees, this cost isn't a percentage of assets. It's structured determined on the death benefit, dollar amount, and the age of the person, the health of insurance. So I can't put an average 1% or something, but it is there. The question really isn't, is there a cost? You know there is. The question is, does the structure create more value than it consumes? But the structure enables downside protection, tax advantage income, death benefit, leverage, liquidity. The goal is a structure that provides superior outcome. NIW has created a website and software. They call it, in the upper left corner, Interactive Learning Information Assistant, kind of a funky name. They call it ILIA for short. I use this particular site all the time. And I'm going to the third thing down, they estimate my benefits. I'm going to show you a hypothetical using this software. I've already crunched the numbers. But the hypothetical, I'm going to use a 46-year-old male, excellent health, willing to put in $70,000 a year for 5 years. Wants a distribution starting at 65, wants to make sure it's happening through 90. We're going to use an illustrated growth rate of 6.81. This is regulated by the NAIF, National Institute Commissioners, State Commissioner, Insurance Commissioners. Get my words right. We're going to use an income tax rate of 37%, state and federal. Capital gain rate at 20%. Why did I choose 46? Why did I choose 70? 46 is the average buyer of Kaizen nationwide. There's younger, there's older. And the 70 is the average amount the 46-year-old is putting in per year. You can see it's not close to the minimum. I've been involved with one case that was putting in $1 million a year for 5 years. So here's what my numbers are, what we're going to crunch for you. We're going to show an after-tax investment, compare it with a tax-deferred investment, and Kaizen is going to be putting this $70,000 a year in for 5 years. We're going to get the 6.81% in all investment options. We're going to see how it does. We're going to have the distribution at 65. We're going to get the total distribution through 90. We're going to show the death benefit if there is some. We're going to show you the death benefit at age 90. Let's get going. After-tax investment, $58,642. Looks pretty good. They're going to receive through age 90 $1,524,000. I wanted this to be the highest amount possible for my illustration, so I made this income through 90. 91, zero income. I've used every penny at 6.81 from that age 46, putting money in through age 65, taking money out through 90. Then tax deferred, this is your IRA 401k. Wow, 74,106. We're going to be able to pull out 400,000 more because we did it in a tax deferred IRA. That's cool. Kaizen. Drum roll, please. What do you think it's going to be? Well, I'm sure you think, well, I wouldn't be showing it to you if it's less than 74. Is it 84, 94? What is it going to be? And it is 130,000. Same return number. Total through age 90, 3,380,000. And we had death benefit day one of 2 million. Sorry, I'll turn that off. I should be careful about that. Death benefit at age 46 of 2 billion, and at age 90, 1,000,007. One more thing on my phone so I don't ring. All right, there we go. So remember that we were talking about insurance costs. This is covered the insurance costs and grown beyond the regular account and the tax deferred account. In a sense, you could say you got life insurance free and continue to get life insurance free. Not the first, it showed a growth time in the first years, but as you are patient, this works wonders. A lot of people right here, they say, Jim, this looks too good to be true. Well, I understand, but I didn't give you bad numbers. This is the actual Kaizen performance. It is true. We have looked over the two worst case environments. We've stress tested Kaizen to see if it works in bad times. First one we looked at is the 1980s, the high rate environment. Loans got up to 16.88. Wow. I started my investment career in 1982 after selling my furniture store. Anyway, we're going to look at the numbers for the 1980s. Then we're going to look at the numbers for the Great Depression, 1930 to 32. This is the worst sequence of returns in U.S. history. We're going to illustrate 9 years of zero return. Notice, not 9 years of negative return, zero return, because we can't have a negative. But 9 years out of 12 at zero, does this thing still work? Well, let's show you. The stress test of 1980, 97,500. Wow, it is lower than 130, but still higher than 74 or 58 in the worst time of interest rates. And, oh, I forgot that I put this slide in. If we're putting this Kaizen to be lower return, then I probably should put these other two as lower, and I use the same percent drop. And so the after tax be 43 and the tax deferred 55. So the 97 is looking pretty nice in this environment. Then we looked at the Great Depression, and it was lower as 84. Notice the 84 still is higher than the 74 or 58. And comparing these other numbers, those would be down probably to 38 or 48. So the 84 is feeling good in this Great Depression era. Wow. I got another drum roll, please. What could I be doing next? Allianz, one of our vendors we use for the life insurance, the world's largest insurance company, looked at our Ilias software. They wanted to really crunch the numbers and see if there's flaws in our design, that it wasn't telling totally the truth. And they discovered something. They said there's an 80% chance, that 80% chance is going to be double. You're probably saying this is too good to be true now. So it could 80% chance it'll be 260, not the the 6.81 return of 130. So we got a range. We got a range of 84 to 260. Beats the options, other options. Wow. Did something else. What if this guy, this 46-year-old, was not excellent health? He was average health. Well, the 130 now went to 120. Wow, not bad. And we see the stress test numbers, okay. And the double still obviously okay. So at average health or excellent health, it looks very good. And what if it's a female? Females, 100 instead of 130, they have better longevity. It'd be 133. So average health or excellent health, female, it doesn't matter, it works. Now I want to go back in history a little bit. The very first policy was issued in 2012. And this is a statement from one of the owners. And the statement comes out every year from every policy. And this is June 27th, 2025, almost another year since that statement, not quite. And this person, who's one of the owners of NIW, her average return has been 7.85. Not bad. And she's paid an average interest on the borrowing of 3.95. And so we can create a spread. 7.85 subtract 3.95 is 3.9, meaning she's made 7.85 on her money. She's made 3.9 on the borrowed money. That sounds okay. Borrowed money. I want to add something else to this. This slide, I haven't done it. NIW did a study looking back to the 1930s. What has a spread? What could be the spread from all different times? And they discovered that there probably there's never been a spread less than 2% in any 15-year period of time. So now we kind of know what we'll probably, on the low side, we could be making 2% on other people's money. And on the high side, 3.95, maybe higher than that. Now, long-term historical SP 500 averages is about 10%. So you look at the 7.85 and you say, Jim, I wanted 10. Well, yeah, but this is tax advantaged. So to make this a fair trade, I'm just going to take 25% of the 10% for taxes and say that average 10 is 7.5. So the 7.85 looks right in line and a nice return. It works. The Kaizen principle. Most people focus on outcomes. Wise people focus on how the system is structured, because results rarely fail from lack of effort. They fail from poor design. Inversion teaches us to ask a better question. What results do I want? That's not the question, but what structure produces the results consistently? Because success is not an event, it's a system. Structure first, results second. Transformation follows the structure. How can you learn more about Kaizen? I've got 4 ways. We have a landing page that has 10 chapters, a lot of information, has a lot of videos, and there's the front page of it. And you can take that QR code, make a picture of it, and you can go to this landing page and study Kaizen to your heart's content. It's all there. And my phone number is on that landing page, so you can call and ask questions of me. That's the first one. Second one, we have a similar landing page for those who are using it for gifting, what we've been talking about today. It's It's really kind of a little different approach. So we have a complete landing page with videos and chapters about the gifting angle. So there's number 2 way. The third way is this ILIA site that I showed you. You have to have a login and password for this, but not a big deal. If you want access to this one, send me a request to email, text me, I need your birthday, your cell phone number, your email, and I guess your name. And you could have access to this and study it from this point of view. And you could just go to my website. I like to think my website is really robust. I keep trying to improve it every week, all the time. I've got a lot of links on it to help you. I've got a retirement income gap calculator that I built. That's easy. This is the basic. I've got a advanced. Starting to lose my throat, my voice right now. Maybe it's good that we're about the end here. Engagement. How do you want to engage? There's the online I've been showing you, and I can help with questions as you want that. So online or one-on-one, traditional. I'll take you to lunch, take you to dinner, answer your questions one-on-one. It's the same strategy, however you approach it, just different engagement styles. I know everyone approaches this differently. I let you do it the way you want to do it. Our Kaizen service model, after you own it, there's myself, but OakTree, but then there's also the program oversight by NIW. They're involved highly through that 15 years for sure. Then there's the institutional part, the insurance carrier, the commercial lender, the trust company. You can see there's different entities, and then continuity. Even if I'm no longer involved, then all this other stuff's going to be there. I added this week, the Kaizen Swiss Army knife, a complete financial tool set, structure before strategy. There's the protection, living benefits, low loss, sequence protection, behavioral protection, creditor protection. There's the growth, compounding, acceleration, efficiency. There's the control, liquidity control, 5 payments, riders, turnkey. There's the leverage, 3-to-1, no non-recourse, capital efficient. There's the tax and transfer, tax-free, tax diversification, no require minimum distribution, estate efficiency. I didn't even want to show you a knife with all those blades. There's a lot of things there, and it does a lot. This structure is pretty cool. My best clients, what do they like the most? Oh, did I? Oh, okay, I forgot I put the slide in. these are the 5 things that client has told me mean the most to them. 0 downside floor, tax-free, finite funding, 5 years, death benefit and living benefits, and flexibility. These are the 5 things they like. So I highlighted those. There they are. Protection, tax-free, control, no living benefits, no loss. And then I looked at the list and said, wow, there's some other things that I think is awfully important. And so I added mine. Growth, leverage, non-recourse, sequence protection, behavioral protection, credit protection, turnkey, no RMDs. And even the white ones are important things too. Anyway, there's a lot of things that Kaizen brings to the table. So after 35 years in the business, I've learned to separate products from structures. Most financial tools are products. A few are structural. When someone has the runway, the time, and the health to qualify, I've yet to see a more efficient long-term structure than Kaizen. Is there a better way? Webinars. There we are, the third one down. Monthly, we do, every month I do the flagship, all the details about Kaizen. Then I do one on retirement income, the family gifting, bi-monthly executive employee benefits, and business succession. That's the 5. I'm actually working on a few other ones, but I don't have them ready. Here's the webinars already booked. May 20th. Take a screenshot of these. This is the registration links. Business succession, wealth building, my flagship, retirement, family gifting, this one today, a month from now about, and employee benefits. That's the webinars for the rest of May and June. Well, I hope you've got some insights and some ideas. I love Kaizen. I think it's the better way. There's those 2 QR codes for those 2 sites. There's my office phone number. There's my email. There's my website. I hope you've enjoyed being with me today. And as you have any questions, give me a call. And with that, have a great afternoon. Bye.